In today's presentation, we're going to talk about using market correlations and how to use them to qualify better trade opportunities. And when we say better, we're looking more for low risk, high probability trades that are shorter term in nature, but you could start with a correlation trade on a day trade opportunity and extend it out to be a swing trade. One thing that I always mention is whether you're day trading or swing trading, no matter what you're doing, you're still day trading. Because on a swing chart, you might be looking at a 4-hour daily chart, but your entry happens on a nanosecond. So therefore, all trades are actually intraday trades. So what you're going to learn here in these market correlation this video here that we're presenting to you, you're going to learn how to apply this on a shorter time frame and how you could leverage this for long-term opportunities as well. So I'm going to teach you what is relationship and correlation. All right, we're also going to look at asset allocation theory very briefly and how portfolio management actually dictates. Sorry, there's a squawk that just came in, and how it uses to dictate the actual market. There's a big influence on traditional portfolio theory over equities even to this day. Which markets are correlated and why, how to find daily correlations, and how to build trading triggers on correlations. All right, so we're going to talk about a lot. First, I'm going to introduce myself very briefly because Renee did a wonderful job. I appreciate that intro. And what we're going to talk about, I worked as a trader in one of the big 6 banks. I did various roles. I started as customer service, got licensed as a trader, sat on the desk, did some sales as well. And in 2009, I saw the market collapse, and I saw a lot of our clients at the bank lose a ton of money. And sadly, it caused a lot of damage, but there was an opportunity in it all. There was an opportunity for you to actually have been down on the short side, and there were a lot of cracks starting to appear before that wet. If you could think about what happened in 2009, it was your paper cup. Like if you look at the coffee cup you have right now, Starbucks, whatever it is, the more the coffee sits in there, the more that bottom starts to get wet, the wax starts to seep through, and eventually that bottom will fall out. All your coffee will end up on your pants. That's what ended up happening in 2009. There was a lot that led up to that collapse, and the saddest part for me was knowing that it was coming and not being able to do anything about it with our clients. I saw them lose a ton of money. So on that, I started to think about how can I provide my knowledge to the retail group? How can I provide the everyday investor the opportunity to not only protect themselves, but maybe even make an active income on the downside? Because there's a saying, stocks take the stairs up and the elevator down, and that's exactly what happened, right? It went down really fast, and the faster it goes down, the more panic selling there is. Fear is always stronger than greed, and that fear drove a lot of opportunity for the investor that was watching for it. So we started Trade Pro Academy in 2012 with the mission to educate the retail trader to trade like a professional. All right, since then I've traded and traveled the world. This job offers you a really good opportunity to be self-employed and manage your own schedule. The picture you see here is me trading in Bali. I have my 3 portable monitors set up, and that's how I trade on the go. All right, in 2018, I took trading education to another level. There's a lot of trading psychology you'll learn about, and they'll say things that are very straightforward, like don't average into a losing trade. But it's easy to tell somebody not to do that. It's hard to explain why the brain automatically resorts to you doing the worst thing while you're trading. All right, it's human instinct, it's human psychology, and oftentimes you'll do a trade and you'll say, my goodness, that wasn't even me doing this trade, when you go to review it at the end of the day. And what happens is there's a self-sabotage cycle and a strong psychology background that leads you to make these decisions. So we created the trading psychology course after I got certified as a master in neurolinguistics programming, life and success coach, clinical hypnotherapy, and time techniques practitioner. You might look at this and say, this is fluffy. Why would you get certified in that? And then you realize professional trading institutions, actually, some of them, the ones that do the most amount of volume, have psychologists on staff on their payroll. And it's a really big psychological advantage to know this stuff. All right, anywho, so traded, traveled the world. That's my fiance at the top left. She's now a wife. So we got married on July 21st. It was fun. We got married in a castle. This is me trying to surf, and then I've mastered it since. Me in a villa in Bali, doing some stuff out west, trading in the Bahamas, being hypnotized, hypnotizing somebody. My certificates, trading with a 2.2 liter beer bottle in Bulgaria, my motherland. That's actually cheaper than a 2.2 liter bottle of water. And then last but not least, trading in the car. I trade on the go. I do whatever I can. And basically, I've been around the industry for a long time. what I wanted to tell you about asset allocation is this, and let's get into it, that portfolio management theory attempts to balance risk and reward by diversifying into separate asset classes. All right, so there's a few main asset classes that you're gonna experience, and you may or may not know about. Equities and bonds are the two primary categories that portfolio managers put money into. And when you think about who's a portfolio manager, it's somebody who's been tasked to manage money by clients who've been solicited and sold by institutions. So this is your everyday people who want exposure to the market but don't want to deal with it. Right? If you don't want to actively manage your own money, somebody's going to do it for you and you pay them. And that's the real big flow of assets that go into the market. The institutional market is way bigger than the retail. So one thing you got to understand, and institutional money managers are the ones that dictate a lot of the allocation theory. So you have two different classes, equities and bonds, and cash is a third component. So now you have the three components: equities, bonds, and cash. And portfolios that are created are managed primarily between these three categories. All right. The way that the breakdown of the portfolio is, it's called an asset mix, and a 50-50 is considered a balanced fund. So if your advisor tells you, hey, I'm going to sell you a balanced fund, on a 50-50 split, that means you're half into equity, half into bonds. All right, 80-20 is an equity fund, it's aggressive. And how do these portfolio managers tell you what asset mix makes sense for you by client life cycle? Well, it's based on your age. All right, so some CFA people that graduated thought it was a brilliant idea to split everybody into just 5 categories. And you know, obviously that's changing a lot with robo-advisory and HFT trading that matches your lifestyle a little bit more. But at the end of the day, there's always categories that you're grouped into and your money's invested based on your category. And I've heard a lot from retail clients saying, well, that's terrible, well, that's a bad approach. And I would always say, well, then why don't you manage your money? You could make a custom tailored asset mix. Anywho, the idea is that as you progress in your life cycle, or as you get older, more wise, we should say, you should cut back on equity, which is the blue scale, and increase your exposure to bonds, because bonds provide a fixed cash income and a fixed cash flow. And the older you get, the less likely you are to be able to survive another down cycle in the market. And it's not morbid, it's just the truth, right? If you're in your 60s and you're retired, you don't really want to be sitting through a massive stock market crash if that's what you're relying on for your income. So what we don't realize as traders is that this plays a huge role in how we day trade as well. And this is what we're getting to here. All right, now let's go through an example. Who wants to be an equity fund manager here? I'm going to use one of you guys. Renee mentioned that we like to be interactive. I love to be interactive. So who wants to say aye in the chat box? Just a fun little example. Geez, you can't even give away portfolio manager jobs anymore. That's how the industry's changed. All right, Christopher says he'll do it. All right, Christopher, your LOL was a buy-in. All right, Christopher, you're charged right now. You're fund manager, and we're hiring you to manage a portfolio with an asset allocation of 50-50. Right, so your mandate is to put half the cash that we give you from our investors into equities, half the cash into bonds. All right, so it's pretty much the life cycle stage where you're probably early to mid 40s. Christopher, here's what we do. We give you $20 million of client funds we've collected. Your job is to put 10 million in stocks, 10 million in bonds. Would you be able to do that? Welcome, Priscilla. Happy you got a chance to get in. This is recorded as well. You could do that, right? You could find some opportunities as a fund manager. That's why we hired you, Chris. All right, Chris, you playing along here? Stocks go up 10%. All right, so now the value of this portfolio is $21 million in total. Congratulations, you made a mill. Stocks go up to 10%. They go up by 10% rather. And now the new valuation for your stock portfolio is 11 million. Your bonds are 10 million. All right, Christopher, you did good. Yeah, Christopher, you did do good. 20% is your performance fees. All right, so portfolio total is $21 million. But if you go to a 50-50 million or 50-50 split rather, Christopher, your investors have said, I want to be in a diversified, balanced fund. So are you doing a good job for your investors? Yes, you made money, but you are not giving them right now what you promised them, right? You're overvalued in where? in equity, right? So you now have an overvaluation of stocks, and what do you got to do, Christopher? What do you got to do to balance your fund? Reallocate, exactly. So what you got to do is sell 500,000 of stocks and at the same time buy 500,000 of bonds. That right there is an asset mix reallocation trade. And regardless of what's happening in the market, all right, Donald Trump could be tweeting something, and there's a good likelihood he is if 13 seconds have passed. The Turkish lira is crashing. Erdogan's doing a speech every 13 seconds himself. It doesn't matter what's going on, regardless of what's happening, Christopher. You're going in there, hitting the bid on 500K worth of stock, and you're lifting offers on 500,000 of bonds to reallocate your portfolio, right? So it's irregardless of market sentiment, you're doing this trade. Well, look at this. This reallocation trade is what it's going to do is temporarily push down the prices of stocks and bid bonds higher. Do you agree? You guys understand now your job as a portfolio manager? It's that boring. Portfolio management is a very boring job, especially when you realize that all these decisions, Christopher, that you made in purchasing the stocks that you made $1 million, it's not you, it's your computer model that's been generated for you. All right, so what is correlation? It's a mutual connection or relationship between two things, and the degree to which two assets are related is known as a correlation coefficient. It's called CC. And the higher that value is, so anything up to 1 means you're perfectly positively correlated. If you're a +1 correlation with your spouse, it means you're completing each other's sentences. All right? If you're a -1 correlation, it means you're exact opposites. You know, you say, hey, where do you want to go for dinner? And she says, I don't even want to go for dinner. It's a -1 correlation. So it's the efficient to which two assets, or the ratio to which two assets move either together or directly apart. So apart means inverse correlation, together means positively correlated. Okay, do you guys follow? What are bonds and stocks? Positive or negative correlation? Are they +1 or -1? What would you guys guess? Inverse, says Priscilla. There you go, Priscilla, you joined late and you're already crushing it. You're right, inverse correlated, so they're closer to -1. And I got to tell you this, nothing is completely -1 or +1. It's somewhere in between. And if you wondered why, remember, you're buying stocks and selling bonds. So one asset goes the other way, the other one goes the exact opposite. So that's why they're directly inversely correlated. And we'll go through some examples here. All right, so here's some positive correlations. Joel even knows the number, says 0.89. Yeah, it depends which bonds and stocks indices you're comparing, Joel, but it's right in there. 0.9 is pretty close, -0.9. You know, some of them go as high as 95, 96, but it's never perfect. Nothing's perfect. By the time the person does the calculation to give you that number that has their CFA, it's already changed. So nothing is it's all real time, right? So here's your S&P 500 positive correlations. That means these are things that are moving together, lockstep, in sync at the same time. The S&P 500 correlates positively with NASDAQ. And in fact, NASDAQ is what we call a leader. It is a market that when the S&P 500 goes up, NASDAQ should have been moving higher first. It tends to move first. All right, Dow Jones Industrial Average, or just the Dow, Charles H. Dow, the grandfather of technical analysis and the first index ever created. All right, Russell 2000 is also positively correlated, and the DAX, which is European equities. And in fact, any market that has risk or that goes up whenever there's a perception, whenever there's a new desire or appetite for risk, if that market goes up, it's probably positively correlated with S&P 500. You can call this basket risk assets. So whenever there's risk elevation, they go up because that's where the money is going to bid them up. All right, oil is also somewhat positively correlated, not always. Of all the correlations, that's the most diciest, and other risk on assets. All right, are you guys starting to think here, hey, how could I use this for my trading? Hopefully the light bulb's gone on already. If it hasn't, don't you worry, I'll flick the switch for you in a minute. All right, so how true is this and how possible is this? We'll look at S&P 500, which is the candlestick chart. The Dow is the orangish chart, and the NASDAQ is the light orange, okay, or yellow almost. So as you could see, NASDAQ is the leading market. NASDAQ has outstripped gains on a weekly chart going back to the crash of 09. This can be summarized since '09 as either a tech bubble and or a central banking inflated bubble. And I wouldn't call it a bubble quite yet, but you could see strong gains. And what you will see is that assets move lockstep. You see the rally out of '09 pull back. Same thing happened in NASDAQ, same thing happened in Dow, same thing happened in S&P. Continuation, continuation. If you squint your eyes, you could see they move in very correlated and similar fashion. In fact, the bottom here is what it's called your correlation coefficient. Created that chart using TradingView. If you add study called CC, you could look at the correlation coefficient between any asset. And you can see it's very near 1 pretty much all the time. There is periods where it decouples a little bit, but it then tends to float back to around a 1 correlation, positively correlated. All right. Now let's look at these assets a little bit individual. S&P 500 versus the DAX. You can see very positive correlation. They move lockstep. All right. S&P versus oil. Here's where it tends to move well, and then there's periods that last up to a couple of months that could inverse or go inversely correlated. So since about 2014, the oil equity correlation hasn't been perfect, right? And you need to know that when you're trading, applying this to your own strategy, you ask yourself, what do you trade? You're trading Forex. What currencies are correlated positively and negatively? So this is all we're trying to find out right now, and I'll show you how to trade it in a brief moment. Money Tree said, is this recorded? Yes, it's recorded. You have to follow the Investor Inspiration YouTube channel, and they upload it there. You could definitely not hedge the S&P 500 with the Dow. No, you can't hedge it, and you shouldn't. The idea in this is, sorry, Renee, we're going to mention something? Thought I heard the mic. The point is not to hedge it here, Priscilla. The point is to diversify. If you've been giving 50, in the previous example, you've been given $10 million as a fund manager. The point is to put that $10 million split and diversify it into a few assets. So you're not going to be long the S&P 500 and short the Dow. You're going to be long likely all of them. All right, just to give yourself some opportunity for diversification. I'll tell you one thing, the D word, diversification, has been the greatest fraud in the last 10 years. There's nothing that's diversified these days. Everybody's plowed knee deep into these FANG stocks, Facebook, Apple, Amazon, Netflix, Google. There's a real big concentration risk in this equity market. And when it eventually does drop, you're going to see those stocks get battered the most, all right? Because there's no other ways to get gains. All institutional players are putting their top 10 holdings into a small basket of stocks. Guess what? It's great when the party is going, but when the party is over, that means they're all running to the coat check at the same time. Who's going to get their coats and who won't? All right. Here's some negative correlations with the S&P 500, and this is where you start to look at maybe diversification or hedging, like you said. Also, you could hedge with options and futures. We teach all that. We teach options, futures trading. We even launched a Forex course this morning, actually, 9 a.m. So really cool time for me to be here. So with negative correlations, this is the inverse. So S&P 500 has a negative correlation with bonds. We talked about that. It has a negative correlation with the Japanese yen, with the US dollar for the most part, and gold. Okay, so these are assets that are inversely correlated. Silver as well, and other risk-off assets. So if you think about a pendulum that swings, this will help you guys kind of get it. This is the risk on, the RO section. This is the risk off section. All right, so things are going, risk is going well. The pendulum swings on to risk on. Everybody's saying, woohoo, let's celebrate. It's a bull market. And this is the exact opportunistic time you got to start looking at hedging your positions or taking the opposite sentiment, because the pendulum swings right back to risk off. So the question is, if markets are going down, it's risk off. These are the assets that'll tend to perform. And then when the market's doing really well, risk off assets suffer while risk on assets are getting the bid and they're getting pushed up higher. So really, it's just a pendulum swinging and the money flows with it. It's kind of like water in a bathtub. I realize this is probably the strangest example you ever had, but the water swishes one way and then it swishes the other way, one way and then the other way. And that's kind of what happens in markets, is continuous effort to rebalance portfolios against the sentiment changes. All right, so let's have a look at some negative correlations. You see S&P 500 versus bonds. This is your classic inverse correlation. You can see we spent a lot of time closer to -1. We do have periods where bonds and S&P 500 or equities move together. And guess what those periods are? Who could take a stab at this? Look at the period given 2014, the middle of the year, 2016, middle of the year, 2009, the beginning of the year, 2009 towards the end of the year. What are these positive flips? Why are bonds and S&P 500 moving together? This is a bit of more of an advanced question. Look at oil get puke right now. Wow, I'm just looking at the oil chart while I do this presentation. It's because Federal Reserve meetings and or policy changes. Whenever the Federal Reserve goes on to speak and provides the market new information, interest rate hikes, any kind of liquidity increases or decreases through monetary policy, that's going to have the equal effect on both stocks and bonds. They're both going to go up and down at the same time. So around Fed events, be very careful with the bond and equity correlation. All right, it tends to flip from inverse to positive. All right, explaining why that is will take a long time, so I'm not going to do it. Just know it. S&P 500 versus the yen, you could see mostly negative correlation. S&P 500 versus the US dollar, that's a little bit shaky since about 2014. It hasn't really been as much of inverse correlation. It's spent as much time positively as inversely correlated. S&P 500 versus gold, kind of similar. And last but not least, I want to show you guys how to make a correlation matrix. What you need to do here as a trader is check up on these correlations on a regular basis. This is a snapshot. If anyone's in finance or done any fundamental analysis, this is a balance sheet. Balance sheet's basically a snapshot at a period of time. And it changes on a second basis. You don't need to know it that close. All you need to know is generally what are the correlations, what's positively and inversely correlated in the market that you trade. I often get asked, people ask me, should I trade stocks or futures or bonds, Forex, what should I trade? And I always tell them it depends on what your schedule is. Depends on how many hours you choose to dedicate to trading, what hours they are, and what your schedule looks like and what your goals are. Depending on how you answer that, there's a product for you. You shouldn't run to a product based on something you've seen on the internet. You should choose a product because it works for you. That's the only way this industry is gonna make you bank. All right. Now here's the correlation matrix. So wherever you see a high 90, that's positive correlation and it's green. So anything above 90 is highlighted green. Anything below minus 90 is also highlighted red. So these are your correlations. One asset list is down the left, one on the right. They're the exact same assets in the same row. All right. So you can see this little line that runs right down the middle. That's because this is the asset against itself. It's empty boxes, you see it? And they obviously correlate one-to-one. So that means if you're doing the Dow in correlation with the S&P 500, 98 correlation ratio. And now it's 100 to minus 100 is the range. The Dow, however, with the Japanese yen, JY, is minus 90. And if you click this link, there's actually a live table. Steven said, Steven's one of our Trade Pro members that went out here, said, holy crap, fundamental analysis. Yeah, Steven, we're getting into fundamental analysis. We always laugh at, and we say that we're Warren Buffett if we hold a trade for longer than 20 minutes. Steven, you getting some of the sell-off in oil? All right, whoops, there's my trading station. Got temporarily distracted. All right, so how do you find that correlation matrix? Type in MSCI, MRCI is the intermarket correlation. You can look at it. This is a clip from December 27th, 2016. So you should very likely go get an updated one. All right, here's how you trade these intermarket relationships. All right, there's a few strategies. I'm going to show you how to use them. Are you ready, Priscilla? You ready for this? Because up until now, all this was really explaining to you is what is a correlation, what's positive and inversely correlated, but none of it's really going to be the catalyst for you to make money. I'm going to break it down for you right now into very usable information. So get ready for this. Wish we had that song. Y'all ready for this? Anyways, let's continue forward. You could look for 3 different ways to trade this: strength in a correlatory market, weakness in a correlatory market, or trade the reversion. Of these 3, I would prefer that you sort of paid the least attention to number 3. It's the most dangerous. Long-term capital management, LTCM, has single-handedly lost billions of dollars and went out of business using strategy number 3. It works until it doesn't, and if you're the kind of person that never gives up and says it'll definitely do this eventually, then this is the worst for you. So kind of ignore number 3. Let's talk about the first two, strength in a correlatory market versus weakness in a correlatory market. What do we mean by that? Let's break it down here. Milo, that's funny. Trading intermarket strength. All right, how do we do that? So this is strategy number 1, and I'll show you guys a concrete example. And we're going to use futures. If you trade currencies, I'll show you how to do correlations in currencies as well. You see that the NASDAQ market breaks out of a consolidation. You guys remember the chart where NASDAQ was way up here and S&P sort of just slugging along with the Dow? We know that NASDAQ, first of all, has made the most amount of gains since 2009. If you look at 100% of the returns since 2009, NASDAQ's responsible for something ridiculous like 60 to 70%. So those stocks the technology stocks have benefited the most. It's a leader. For this bull market, it's a leader and it'll continue to be a leader. So you notice that NASDAQ's broken out of a consolidation. So it looked something like this, a range. NASDAQ market's broken out. However, the S&P 500 has not yet. All right. Priscilla, let me ask you a question. And Milo, since you guys are the only ones responding, everyone else is lurking, and that's okay. What do you think that means for the S&P 500? Get long or get short? Given that NASDAQ just broke out. Bingo, Priscilla. I'm going to tell you guys one thing. Those people that participate are the ones that get the most value out of this. I found day in and day out in our webinars, the people that are there and participating are the ones that, not surprisingly, get profitable after a while. Because they're doing it, they're eager, they're applying. I don't know about the others because they don't participate, so I can't give you their stats. But exactly, get long the S&P. You get long the S&P for the correlation trade. So what happens is you buy the S&P 500 and you set your stop loss. This correlation trade is not 100% accurate. It's going to fail, you're going to get stopped out. That's okay. Taking a loss is a part of the business. If you can't take a loss, you should get into a business that doesn't guarantee you a loss, but remember, your salary is guaranteed. If the loss doesn't happen, then your salary is guaranteed and it's low because you're not taking any risk. You're not getting compensated for it. So you set your stop and to keep an eye out on NASDAQ. What you do is when NASDAQ goes, Priscilla, you buy the S&P 500 and you hold it until either you get stopped out as you're trailing your stop higher, or it comes in and gives the S&P 500 or NASDAQ the little kiss of them meeting. They meet under the mistletoe and they give each other a soft kiss on the cheek, and then you get out. All right, so your opportunity is really this gap, closing this gap off. Take profit at the first sign that the NASDAQ market slows. If NASDAQ's your correlation leader and you get long S&P and it goes up a little bit and NASDAQ starts to puke, don't turn a correlation trade into hope. Right? Don't say, oh, well, there's no S&P is going to be resilient. No, you got to hear it didn't meet. It's okay. If NASDAQ turns back, you get out, you take your profit on the S&P, you call this a profitable trade because there's a chance they're both going to puke together. All right. So take profit at the first sign of slowing in your leader market. Don't let the correlation trade turn into a swing trade. All right. Don't let a first date turn into a wedding. Do you know what I'm saying? The way you trade is as soon as hope comes into the market, you lose your edge. We kind of have the cross here that you have an edge as you start trading. At the beginning of your trade, your edge is the higher. As time passes, this is time at the bottom, your edge slips and your hope increases. And when your hope becomes greater than your edge, you're out. All right? It's an automatic stop. Could it go wrong if a major component of the S&P fails? It could always go wrong, and it does go wrong. But it goes right more than it goes wrong. You know, you could make money if you're only right 30% of the time if you manage your risk accordingly. So look for it to work and learn from that. And rather than looking to be right, look to be profitable. We stress that a lot at Trade Pro Academy. Being right alone has no value. You can't pay your bills with being right. You can't tell the Mercedes dealership, hey, I'm here for a service. Let me pay you out of my being right account. Right, and tell you, here's the exit, go get us some cash. All right, so let's look at this trade in action, NASDAQ and ES. You're right most of the time, Milo. Are you profitable then? Let me ask you that. NASDAQ takes out the 49-45 structure. All right, and what ends up happening is NASDAQ's the red line, it breaks out to the upside. All right, this is the exact example I gave Priscilla, and she said buy the S&P. So look, you buy the S&P, Priscilla, you buy it right here. You see the green line? And what you see is ES is not rallying. So you know that you could get some buy stops, and S&P is more than likely going to follow the NASDAQ. And so you buy the S&P right here in the green line. And then look what ends up happening. If you got the long here, you had a chance to get in there. And now you're seeing they're both moving together. The second they start to correlate with one another, you're out. You notice how NASDAQ started to turn down? That's it. That was your trade. That was good for 3 handles. All right, 3 handles in the S&P 500 is $150 on a $500 leverage. It's nothing. All right, it's a great return. You could have a $1,000 account. You just made $300 in one day, just off of one correlation trade. All right, and then you see it follow through. NASDAQ starts to show weakness, close some of your profit, or trail your stop loss, or get out. The point is, as soon as the correlation market turns, start to move your stop loss to reduce risk. Not increase it, reduce it. Take profit, move your stop loss higher so you get out of the position with more profit, or just get out and get paid. We love to get paid. One question asked to trade pros very often is, if you don't get paid when you have a profit, when will you get paid? Priscilla just said, wow, what was the light bulb moment, Priscilla? Milo, am I okay to talk about that, what you just said? I am right most of the times, but on the profitability side, he mentions, you know, he has a harder time being profitable, but he's right. So Milo, what I would tell you is stop trying to be right. Stop looking for the perfect trade. Stop looking for somebody to tell you when to buy, when to sell. Just freaking do it and manage risk. One of the greatest tips I could give you, Milo, and this is worth me being here, is if you're having a hard time, if you're being right, but you're having a hard time making money, start scratching trades more. Start getting in with a little bit less like precision. Don't need 30 million things to happen at the same time because you're gonna have less trades. Start getting in quicker and scratching trades. Basically, that means get in, and the second it starts to go against you, scratch for a break even. By scratching trades, you give yourself the confidence that you can get in and out without a loss. Now that removes the need for you to be right, because like, whether I'm right or not, I'm gonna make money if I could scratch my way out. If you could lose less, you're gonna make more. You know what I mean, brother? Brother, man, I don't even know if maybe you're a lady, then sister. All right, number 2, trading intermarket weakness. You're welcome, Milo. Trading intermarket weakness, you would do basically the opposite. You notice that NASDAQ's getting weaker and has slid below the structure support. ES is still within the structure, and I want to show you what that looks like. All right, so look, NASDAQ reverses off this 49.79 level. You can see it's kind of starting to get some lower highs. You know, it's getting at least neutral. Some weakness here is evident. I'm sorry, I'm looking at the wrong line. NASDAQ, you could see lower lows, lower highs. Very evident weakness on the red line. S&P 500 still delusional, thinks it's going up. So what you could do here is short the S&P 500, all right? And tell yourself, as long as NASDAQ continues down and we don't get a new high on S&P, I'm trailing this thing lower, and you ride your stop lower. Just follow that correlation. Look at this. This little blip of a correlation led to a 25-point drop in NASDAQ. I'm going to be honest and transparent with you. I use a chart that it looks really great. Sometimes it doesn't work that good. Sometimes you get 5-6 points. But to drive the point home, you can see what can happen. And you don't need to be right. You just need to catch the right opportunity. The ES catches down NASDAQ. They both continue to slide. Take profit on the downside. Okay? Yo, that's funny. Priscilla, is that a double wow? Is that another wow you're going to put in there? Come on, Priscilla, put 2 exclamations at least. Give me something. Spread trading is the third one. Remember, this is the one I told you not to do. Yes, Priscilla, you could do this with any of the correlated indexes. Just remember, start at the beginning. And what I mean by that is start by knowing which markets are inversely correlated now. MRCI, market correlation, type that into Google. We're not affiliated with them. I don't own the website. So I'll tell you the name. Find out what is inversely and positively correlated right now. Go in and set up correlation charts. What assets do you trade, Priscilla? Sounds like mostly stocks. I'll show you guys Forex in a minute too. Spread trading is the idea that asset A is overpriced and asset B is cheap relative to A, so you basically sell one and buy the other. I'll show you an example. No, I won't, apparently. I don't show you an example. I'll show you what I mean by that. Spread trading is NASDAQ's up here, S&P's down here, And rather than buying the S&P for the delta trade, which means you make money as you're right, or as it moves in your direction, not right. Right's a terrible word. Never look to be right. Look to be profitable. It'll change your life. Instead of doing that, what you end up doing is you short NASDAQ up here and you long the S&P 500 down here. And no matter where they go, all right, they could do this, they could do this. As long as this spread that you got in eventually ends up closing, no matter what the chart looks like, as long as that spread narrows in, you're going to make money. Spread trading is less risky than outright trading, but the profits are less. You need more patience, and it's a whole different ballgame. There you go. Priscilla had another wow. All right. I would tell you guys in the beginning stages of your career, do not fade. Look to just look. Somebody might say, look, NASDAQ's up here, S&P's down here, and I know because of how I'm following order flow, S&P is definitely the weakest. NASDAQ's not going to pull us up higher. Sell the NASDAQ this time through. And there's going to be people that do that. That takes real skill to do that, to know which moments are going to fail. If you try to do that, you're going with the lower probability trade. Right? Other people will say, well, if NASDAQ's strong, why the heck am I trying to buy the S&P? I'm just going to buy NASDAQ. Now you're buying a strong market near a top. Risky strategy and proposition. So stick to what we taught you in step 1 and 2 and apply that, master it, and then expand your skill set. I don't want you guys doing spreads and fading. That's, you know, the people who start and want to fade, meaning that the price is going up and they're like, that's it, it's had its run, I'm going to short it. The people who are looking to fade are the ones that need to be right. They're looking to fulfill a desire of being right, and they're not really caring about being profitable. Right? I find these are the people who in their 9 to 5s are compensated for being right. If you want to go to a heart surgeon, you want somebody who's right, right? If you go to as a trader, I would not hire somebody for a proprietary firm that is looking to be right, because what happens to all the opportunities where you were wrong? You could still have been profitable, right? Joel says, bring this home to Forex. All right, Joel, give me a moment. We're going there, I promise. Intermarket relationship charting, here's what it looks like. So you want to look at your assets separately, and you also want to look at your assets correlated. I'll show you my live chart. I've gone a little bit more complex recently. You can see at the top left here, these are my equity correlations. So I'm not just talking about this, I'm using it. I'm a futures day trader, and that's where I'm more active. But you could see here's my equity correlations. These are my risk off assets. These are my risk on assets. These green and red lines, the red is risk off added up and the green is risk on added up. So it shows me the fear versus greed. Please, patience, says Milo. Okay, that's fair. One can set up correlated charts on MT4 for sure. It's easier on TradingView because I don't know the MT4 platform that well. Joel says info, more experience. There's no wrong answer here because it's what you think, but I'll tell you this, in 2018, information is not it. A proprietary desk does not have any more information access than you do. All right, you get a newswire for 150 bucks a month and you have everything they got. Deep pockets, says Riley. Yeah, that's fair, but are deep pockets helpful if you're not profitable? It just means you could lose more. So a deep pocket or having a well-capitalized account is the benefit of being a professional trader. It's not how you start. You know what I mean? Professional traders start out trading 1 lots and micro lots on Forex. So risk control, bang on, Bob. That's nice. Other people's money. Walter, I find that people actually tend to trade worse with their own money. Anywho, Milo, Milo has deep pockets, but they're empty. All right, Milo, let's fill them up for you, buddy. Here's what I'll tell you guys. This is the truth. Let me show you some famous trading desks around the world. Here's one in the 80s. This is where one of our traders, Steven, is. He invented this computer. He used to trade the Indian spice route, old school. But that's what people think about trading. Great. Here's a modern day trading desk. All right. Here's Bill Gross's fund. Okay. Here is one in Chicago. Here is a notoriously famous Google stock image from a prop firm I couldn't track down. And then most importantly, here's UBS. This is once the largest trading desk, trading floor in the entire world. What do you guys notice about each one of these situations. Christopher, they have more monitors. Yeah, they got too many screens, sure. But what else do you notice? What you might notice is they have something very important that you and I and the retail trader doesn't find as beneficial. The retail trader wants indicators. They want to be spoon-fed trade ideas and signals because that's what seems easy. However, none of these guys look to have anyone's opinion traded on their account. What they have is themselves. They have each other, all right? They have a community. They have a strong presence. They're part of something bigger than themselves. And when you're trading at home in your room by yourself, who's going to enforce your discipline? Who are you accountable to? And going from a 9-to-5 job to a full-time trader, the biggest aspect's accountability. If you're not accountable to anybody, guess what? You're going to lose that money because it doesn't mean anything to you. In a professional environment, you're accountable to your group. You're accountable to your risk manager who reviews your trades. There's accountability and there's support. So the biggest and most important thing about a professional environment you'll notice is they have each other. All right, they have a community. I'll tell you how we have a community at Trade Pro Academy. Swing traders, we have 3 packages, and I'll end it off on this. Our $79 a month subscription package is called the Swing Trader. We have the Forex Mastery course included inside of it. We give you a weekly newsletter. Every Sunday goes out with trade ideas, market analysis, and it's all great. And then we give you a daily email whenever there's an opportunity in Forex. Also, you get a daily email with options trades, market analysis, upcoming data, and a lot of support, plus a chat room for swing traders. Our Day Trader Pro package includes our live trading room. We trade every day, 9 to 11 a.m. Steven's here. Victorio's to the left of me, Mark's behind me, so the team's here on a daily basis. We got a professional environment. We're all looking at the right information and we support one another. The beauty of being in a trading room is if you're long and somebody says, look, I wouldn't be buying this, and you ask them why, and they give you an opinion. That opinion you get to calculate yourself. You say, hey, are they right? What are they looking at? Is that enough to get me out of the trade? So that secondary analysis is really helpful. And whenever you're down, somebody supports you. When you're up, somebody helps keep you humble but celebrate your success. That's the beauty of the trading room. So we do that every day, Monday to Friday, 9 to 11 a.m. Those are recorded and archived. If you can't be there live, you can watch them as a replay. You also have access to our 5 trading lists, our support for multiple trading platforms. We have charting template files, custom indicators, and a live chat for you guys as well. The elite members have everything that Swing Trader plus Day Trader has. And in addition to that, they do a monthly call with me. We cover various topics, whatever the group needs. And they have a 24/5 live trading room where they could chat with each other and screen share. And we open the room to elite traders for news trading, so non-farm payrolls, etc. The biggest value in this is your psychology mastery course. This is not like Mark Douglas trading psychology, where it's don't buy at a low. Great. Now, does he tell you what makes you from your human brain and how you're hardwired to actually do that? How is a human, just by breathing and eating and being a human, you are naturally predisposed to being a terrible trader. Your psychology has been developed to be a losing trader. And I'd love to tell you it's all about indicators and stuff, but it's not. It's all about your mindset. Your mindset's the biggest indicator. And most people are actually dead out of water by the time they sit on the chair to trade. No matter what they do, no matter who they trade or what they have, as long as they sit at the computer with that mindset, it's over. Nothing good comes out of it for the long haul. And that's where the Psychology Mastery course starts. It's not a trading psychology course, it's life psychology and a game changer. We have some reviews, some of our members that have put this together. I'll show you guys. They were kind enough to do video testimonials because they really thought it was a powerful change. And they shared it with us. So if you go to our website, tradeproacademy.com, you know what, let me do this very quickly. And I'll be done, Renee, in 2 seconds. Tradeproacademy.com, 2 seconds is a lie, 30. You go in here and go under the pricing page, you'll see and hear from many of our members who've gone through the process, and they could share that with you. So if you go down, a ton of testimonials, a lot of videos. At the end of the day, the best way to figure out what's going on is just try it. Our product is cheap on an entry level. We have a subscription package. If you sign up and you hate it, 14 days money back guarantee. And you know, it's a month-to-month thing. There's no high ticket purchases to make. Here's the last thing I'm going to tell you. Prices are going up as of September 3rd. This is our first increase in a year and a half. This price will never be this cheap again. $99 for swing trader, $129 for day trader, and $169 for elite. If you get it before September 3rd, you get locked in. All right. Nothing comes from doing nothing. So these are all testimonials I was planning to kind of help you guys with, but I'm not going to read them. I don't know if we have time for questions, but I'll tell you guys this. I invite you to come out and check out what we do at Trade Pro Academy. 14 days, money back guarantee, virtually risk-free.